Hello everyone, this is Grace here. In this video, we'll be discussing accounts of group IFRS chapter 4. So under accounts of groups, it is the accounting procedures of the accounting information of one or more companies together. A consolidated statements will be learnt in this chapter. So before getting into this chapter, we will first know what are the definitions on accounts of group. So we need to remember the three definitions, that is group accounts, parent company and subsidiaries. So what is group accounts is? So before explaining what is group accounts, let me tell when we are supposed to prepare group accounts. Sometimes for the purpose of expansion or diversification or any other long-term business interest, a business enterprise may start up a new sector in order to expand their business. But instead of starting up, many feel that it is better to acquire their any company which might be performing, or which may be smaller in size than their own company, with a similar business idea, so they can acquire the shares of those companies and make such companies as their subsidiary companies. So when two or more companies get in together to start up a business and to develop further in that business, then the accounts what both the companies maintain would be called as group of accounts. So who are the both the companies involved here is parent company and subsidiary company. So parent company is a company who has the ideas and who wants to do further expansion and diversification. So instead of starting up a new unit and expanding their business, they would have made up an idea to acquire the existing company which is already existing in the market with a similar business idea, so that if they acquire that company, the ideas or the techniques or whatever is related to the company will be shared with the parent company. So this parent company, when will they have an option to buy the subsidiary company is when they evaluate and they confirm that this subsidiary company will have, if it is having a good reputation, if it is clicking in the market, or the reputation in the market is good, and they have good clients, and their profit what is being generated is good. When everything has been satisfied by the parent company, then they start acquiring this company in order to make them subsidiary. They usually do this in order to share their ideas, in order to expand their ideas, so it can reach the people or its customers easily. When a parent company, or if a company wants to start other business unit to expand its business, in for that business unit which has been started newly, it takes a lot of time to be achieved in the market. Instead of that, they can merge with the other company which is performing, which is in smaller in size compared to the buying company or the parent company, so which has smaller in size. So when they merge together, they make sure that the competition between them will be reduced, and they can lead the market in a higher position, and face the competitors effectively. So that is why parent company will always decide to acquire the subsidiary company who satisfies all the evaluation process of a parent company. So let me explain what is a parent company. So before that, there are many reasons for business operate as groups. For the goodwill associated with the names of subsidiary, for the goodwill they merge together and they operate business with the subsidiary for tax and legal purposes. In many countries, the company law requires that the results of a group should be presented as a whole. Yes, so when you are merging with the parent company and subsidiary company, the results or the outcomes what you get, or the balance sheet and profit and loss, should be together or consolidated. So when those accounts are being made together or maintained together as a consolidated, then it is called as group accounts. So it is traditional accounting terminology. A group of companies consists of a parent company and one or more subsidiary companies which are controlled by the parent company. So now, what is a parent company is? A company shall be deemed to be a parent company of another if and only if that the other is its subsidiary. Thus, a parent is one which has acquired control over one or more other countries. It is called a parent company when it acquires the shares of the other company. When it acquires the shares of the other company, in the sense it should acquire at least 51% of equity share of the subsidiary company. Only then it can represent itself as parent company. So when is it subsidiary is a company shall be deemed to be subsidiary company of another if and only that other company controls the composition of board of directors, that other company holds more than half of the nominal value of its equity share. So when can it be called a subsidiary is when the other company, that is its parent company, acquires its share which holds more than half of the shares of the subsidiary company. And when they acquire the shares of the subsidiary company, the parent company has the right to involved in the activities or management activities of the subsidiary. They have the right to make decisions. They can act as board of directors because they are the majority shareholders who have bought 51% of shares from this subsidiary company. So they can act over in decision making process of the subsidiary company. When a subsidiary company, it is called as a subsidiary company when the shares are being acquired and when they act as the involvement or in management decision or be acting as a board of directors, then they can, such company will be called as subsidiary company. So when these parent company and subsidiary company are getting into a business, their balance sheet and profit and loss should be shown together. So that balance sheet and profit and loss which is consolidated will be called as group accounts. Group accounts, the way you are going to maintain parent and subsidiaries information, you will be learning in this chapter. So next, the legal requirements as to information regarding subsidiary. The Company Act 2013, the following must be attached to the balance sheet of a parent company. So when you're preparing a balance sheet, when you are getting into a parent and subsidiary company and preparing the balance sheet, the following should be attached with the parent company's balance sheet. That is, a copy of a balance sheet of the subsidiary, a copy of the statement of profit and loss, a copy of the report of its board of directors, a copy of the report of the auditors, a statement of parent's company interest in the subsidiary, a profits of subsidiary so far as they concern the parent company. See, also all the copies of the subsidiary companies, that is balance sheet, profit and loss, report on board of directors, report of auditors, and what is the share which is being bought by the parent company in the subsidiary company, and other related concern about the parent companies, about their profits and how many subsidiaries are there, should be enclosed with the parent company's balance sheet. So now the next topic what we are going to discuss is consolidated statement of financial position. The following steps are then taken in order that the consolidated financial statement should show financial information about the group as if it was a single entity. The carrying amount of the parent's investment in each subsidiary and the parent's portion of equity of each subsidiary are eliminated or cancelled. The non-controlling interest in the net income of consolidated subsidiaries are adjusted against group income to arrive at the net income attributable to the owners of the parent. Non-controlling interest in the net assets of consolidated subsidiaries should be presented separately in the consolidated statement of financial position. Other matters to be dealt with include the following. Goodwill on consolidation should be dealt with according to IFRS 3. Dividends paid by a subsidiary must be accounted for. Ind AS 110 states that all intra-group balances and transactions and the resulting unrealized profit should be eliminated in full. Unrealized losses resulting from intra-group transactions should be eliminated unless cost can be recovered. So all these points, that is to prepare a consolidated statement of financial position, you need to remember. Before understanding all these points, you need to know what are the each items involved in this point. So where I will explain you, the next slide will be the steps involved in the preparation of consolidated statements. When I explain you all what is the steps involved in the consolidated financial statement, you will clearly understand all these points. So at the end of the chapter, you will be understanding what is this, what is the consolidated statement of financial position after solving various problems related to this topic. So now let us get into the procedures. When you learn the procedures, we will come back to this slide after the procedures, so you will understand clearly what is non-controlling interest and other, what is parent company, what is a portion of equity, what is goodwill on consolidation, what is dividend paid, and what is unrealized profits. So the next slide is steps for the preparation of consolidated financial statement. Step 1, calculation of ratio. So your step 1 is calculation of ratio. Under this step, what you need to calculate the ratio of the subsidiary as well as the parent company. In the process of preparing consolidated balance sheet, ratio of holding is of utmost important. It can be calculated as explained. Ascertain the total number of shares in subsidiary company by dividing the total share capital by the face value per share. Then ascertain the number of shares of the subsidiary company held by the parent company. Ascertain the number of shares held by minority shareholders. Calculate the ratio of their respective holdings. This ratio will be used to will be used in the distribution of capital and revenue profit. So what you need to do in the first step is calculation of ratio. You need to ascertain what are the total number of shares in the subsidiary company and divide the total number of shares by the face value of the share. Then you need to ascertain the total number of shares of the parent company. Then you need to ascertain the number of shares held by minority shareholders. So who are these minority shareholders? Apart from these parent company share, apart from the parent company acquiring the subsidiary company shares, there are other outsiders or public who come and buy the shares of the company. So they are called as minority shareholders. Then after ascertaining all these three, we will calculate the ratio. This ratio will be used to ascertain or distribution of the capital profit or revenue profit based on the ratio to all these three parties, because they all three are investors where they are supposed to divide the profit among each. So next is, as this ratio will be used for the distribution of capital and revenue profit, you need to know what is capital profit. So the next step will explain you what is capital profit, and the third step will explain you what is revenue profit. Step 2, pre-acquisition profit or capital profit. So after ascertaining the ratio, you need to find out what is your pre-acquisition profit. It is also called as pre-acquisition profit or capital profit. That is, the reserves created by the subsidiary company and the profits earned by the subsidiary company up to the date of acquisition of shares by the parent company is called capital profit. That is, the reserves which is being maintained by the subsidiary, the reserves as well as the profit which has been reserves which has been created, and the profit which is earned by the subsidiary company. That is up to the date of acquisition. That is up to the date at which the parent company is still not bought the subsidiary. That is up to the date of acquisition of shares by the parent company is known as capital profit. So all the profit which is earned and the reserves of the subsidiary company till the date of acquisition is known as capital profit or pre-acquisition profit. So using the ratio of holding, that is the first step, using that ratio, outsider share and parent company share of capital profits can be ascertained. The outsider share of such profit must be added to non-controlling interest. The parent company share of such profit must be added to the face value of shares held by parent company while calculating the goodwill or capital reserve. So that will be the other steps. So first we will understand what is capital profit and pre-acquisition profit. So the profit which is earned by the subsidiary company before acquisition of the parent company, that is the profit as well as the reserve, is known as capital profit. So what is the format for it is calculation of capital profit, reserves on the date of acquisition of shares. So what is the reserves till the date or on the till the date or on the date of acquisition of shares, then profits on the date of acquisition of shares. With that balance you will add increase in value of assets. If there is any increase in the value of assets, you will be adding, and you'll be minusing in decrease in the value of asset. Then you will add decrease in the amount of liabilities, less increase in the amount of liabilities. So it is vice versa. When the asset is increasing you will add, and when the liabilities is decreasing you will add. And you will minus when the asset is decreasing, and when the liabilities is increasing you will minus. So please remember this. So you will add the capital ratio, or to find out the capital profit, you will look into the reserves up to the date of acquisition of the subsidiary company, then the profit which is earned up to the date of acquisition of subsidiary company. Then you will add increase in the value of asset, then minus decrease in the value of asset, add decrease in the value of liabilities, and minus increase in the value of liabilities. So with this you will get your capital profit. Next is step 3, post acquisition profit or revenue profit. So you can understand with the post acquisition profit or revenue profit, this is a profit and reserve which is earned by the subsidiary company after it has been acquired by the parent company. So that profit is known as revenue profit. So now the steps or the calculation of revenue profits are reserves created after the date of acquisition of shares and profit which is earned after the date of acquisition of shares. With that balance you will add excess depreciation charged on decreased value of asset. That is, you will add what is the excess depreciation which is charged when the value of the asset is decreased. Then you will minus under depreciation charged on the increased value of asset. So any depreciation which is charged on the decreasing value of the asset you will add, and any depreciation which is charged on increase under depreciation charge on the increase value of the asset you will minus. So that will give you your revenue profit. Next slide is for step 4, calculation of non-controlling interest. So calculation of non-controlling interest. So what is non-controlling is parent company may not purchase all the shares of its subsidiary. When some of the shares of the subsidiary are held by outsiders, their interest in the subsidiary company is known as non-controlling interest. That's what I have explained you all these shares were not being acquired by the parent company. There are some shares which is being given to the outsiders. So when their interest or dividend is given to such company, then such interest what is earned or such dividend what is earned, or such part of shares of that of such outsiders is called as non-controlling interest. So they are also called as minority shareholders. So face value of shares, the format will go like this: face value of the shares held by minority shareholders. You will add proportionate share of capital profit. You will find out capital profit in the second step. Then the ratio which you have found out in the first step will be used for distributing it to minority shareholders. Then you will add proportionate of share of revenue profit. With that balance, if there is profit, revenue as well as capital, you will add. If there is loss, revenue as well as capital loss, you will minus with the face value of shares held by minority shareholders. So next is step 5. You will be calculating what is goodwill, or it is also called as cost of control or capital reserve. So goodwill, cost of control or capital reserve. So how will you calculate goodwill is, or what is goodwill is, when the parent company purchases the share of subsidiary at a price which is more than the paid up value of share. The excess amount paid represents payment for goodwill. Yes. So the word goodwill is nothing but the reputation of that company. So when it is being recognized at the higher value than the exact worth of the asset, that higher value or the recognition of that higher value is known as goodwill. So when a parent company purchases the share of a subsidiary company at a price which is more than the paid up value of the share, the excess amount paid represents payment for goodwill. So the excess amount what is paid by the parent company to the subsidiary company, that payment is known as goodwill. The amount of goodwill will be shown on the asset side of the consolidated balance sheet. So the amount of goodwill will obviously be shown in the balance sheet on the asset side of the consolidated balance sheet. When the shares are purchased by the parent company at a price which is less than paid up value of the shares, then the difference represents capital reserves. Yes, when the shares are purchased by the parent company at a price which is less than the paid up value of shares, then that difference represents capital reserve. So when it is being purchased at excess, then it is a goodwill. When it is being purchased and there is difference which is less than the paid up value of the shares, that difference is known as capital reserve. So the amount of capital reserve will be shown on the balance sheet side of the consolidated balance sheet. It will be shown on the liability side of the balance sheet. So the format which is used for the calculation of goodwill or capital reserve is purchase price or cost of shares held by the parent company. You will add parent company's share of capital loss and you will minus the face value of shares held by the parent company and parent's company share of capital profit which is earned in your step 2. So purchase value or cost of shares held by the parent company, add parent company share of capital loss, then you will less the face value of the shares held by parent company, and you will again minus parent company share of capital profit. So that difference what you get, if you get a negative balance, it is called as capital reserve in this format. If you get a positive figure, then it is called as goodwill. So the next step is step 6, unrealized profit. When the stock of a parent company includes the goods supplied by subsidiary company, or the stock of subsidiary company includes the stock supplied by the parent company at a profit, the profit included in the closing inventory at the date of consolidation is known as unrealized profit. While all authorities agreed that some elimination of such profit should be made, not all adopt the same view as to the extent of elimination. Where a non-controlling interest is involved, it is considered by some that the whole of such unrealized profit should be eliminated by creating a stock reserve. That the whole of such unrealized profit should be eliminated by creating a stock reserve. Others are of the opinion that the parent company's share of profit alone should be eliminated, since for the minority shareholders the profit is nothing but realized profit. So what is unrealized profit in short is, so the meaning of realized profit is when a goods or any stock which is sold to the other party at the higher price than the cost value, where you get extra income from the sales what you make than what you have spent. Then when it is sold for cash and you're receiving that profit, it is called as realized profit. When you're selling it and you're receiving cash for it with the profit is known as realized profit. When it becomes unrealized profit is when it is a relation between a parent and subsidiary company where they exchange stock, where a subsidiary company has acquired certain stock of the parent company and the parent company is acquired certain stock of the subsidiary company. So here there will not be much involvement of cash. That is, it is like asset of the subsidiary as well as the parent company is treated as the same between each. So they are acquiring between each other. So it will only be shown in the balance sheet or in the paperwork of the financial statement. Rather, instead they don't receive any cash for the asset or for the stock which has been transferred from the parent company to subsidiary company. So that is why it is called as unrealized profit. Realized will be only when it is being sold for cash and the profit is being earned. As this is an interchange of goods from parent to subsidiary, which will be shown in the financial statement while recording it in a paperwork or in the financial statements, but it will not give any profits. That is why it is being termed as unrealized profit. So next we will get into the problem, so you will clearly understand what are these steps and how these steps will be working on. So the problem 1 is illustration 1, problem on calculation of capital profit and revenue profit. So X company limited acquires 8,000 equity shares of Y limited. So your parent is X and Y is your subsidiary on 1st April 2014. The following are the balance sheet of the two companies on 31st 3 2015. Then they have given equity and liabilities for X and Y. So X is your parent, Y is your subsidiary, and asset is also given. Then they have stated equity share capital rupees 100, general reserves from 1st 4 2014, profit and loss 1st 4 2014. profit during the year 2014 and 15 is also given. So this is the general reserve and the profit which is still first for 2014, that is before the or on the date of acquisition. So this profit is after acquisition, that is profit during the year 2014 and 15. Sundry creditors, bills payable, assets, land and building, plant and machinery, investments. What is the investment made by the company is it is shares in Y Limited. So shares in Y Limited is being acquired. So that is the investment. So who's acquired? That is X Limited has acquired shares of the Y Limited. So that is why it is in the column of X Limited. Inventories, sundry debtors, bills receivable, cash and cash equivalent. And they've asked us to calculate capital profit and revenue profit. So first step is, as per the steps which we have discussed, your first step is calculation of ratio. What I explained in calculation of ratio is, you will know what is the share of subsidiary company, you should know what is the share of what parent company, and the share of minority shareholders. I've explained who are your minority shareholders are nothing but your outsiders. So what is the share of Y company, that is your subsidiary company? We will look into the question. So it is 10 lakh shares of rupees 100 each. So now number of shares in Y company, that is Y is nothing but your subsidiary company, is 10 lakh rupees at rupees 100 per share. So how many shares? 10,000 shares. So number of shares you're supposed to find out. Next you need to find out number of shares held by X company, that is your parent company. So it is 20 lakh shares of rupees 100 each. So 20 lakh shares of rupees 100 each. So 20 lakh divided by 100, which will give you 20,000. So in this 20,000, so the information, so the 20,000 shares is the shares of the X company, that is your parent company. So here we will be only looking into the subsidiary companies. So whatever we are working out or in the calculation, it is all about subsidiary company. When we prepare the balance sheet, we will show parent as well as subsidiary company share. So the calculation or the solution or the steps what is involved here, everything is related to the subsidiary company. So now in the step calculation of the ratio, we have found out what is the total number of shares of Y Limited, which is 10,000. In this 10,000 shares, how much is X acquired is in the question. X company limited acquired 8,000 equity shares of Y Limited. Yes, out of this 10,000, X is the parent company which has acquired 8,000 shares, and what the difference, that is 10,000 minus 8,000, the difference is 2,000. The 2,000 shares is being acquired by the minority shareholders. So now the ratio here is 8 is to 2. So the number of shares held by minority shareholders is 2,000. So the ratio here is 8 is to 2. With further simplification, it will be resulting to 4 is to 1. So your calculation of ratio is done. So in this ratio, first we will find out your subsidiary company shares and how much has been acquired by the parent and subsidiary. Then we will find out the ratio. So that ratio of parent and subsidiary for distribution of the profit which has been earned by the subsidiary company. So your second step is calculation of capital profit. So in calculation of capital profit, you have the format. So you have the format which states reserves on the date of acquisition of shares, profits on the date of acquisition of shares. Then you will add increase in the value of asset, less decrease in the value of asset, add decrease in the amount of liability, less increase in the amount of liability. So now we have calculation of capital profit. First you need to find out the general reserves and profit which is up to the date of acquisition. So the general reserve, that is first for 2014, that is nothing but up to date of acquisition. What is Y's general reserves is 2 lakh. Y's general reserve is 2 lakh and profit and loss is 60,000. As the general reserve is 2 lakh and profit is 60,000 up to the date of or on the date of acquisition, we will be taking that in calculation of capital profit. So general reserves on first for 2014 is 2 lakh and profit for first for 2014 is 60,000. So the total is 2 lakh 60,000. So this 2 lakh 60,000 will be divided based on the ratio which has been earned by the parent and minority shareholders. So the ratio is 4 is to 1. So 2 lakh 60,000 for the parent first, share of X company who is a parent company. 2,60,000 into 4 divided by 5. How did you get 4 divided by 5? 4 is to 1, which is nothing but 4 plus 1 will give you 5. So 2,60,000 into 4 divided by 5, which will give you 2,08,000. Then share of minority shareholders, 2,60,000 into 1 divided by 5, which will give you 52,000. So this is the share of X company limited and Y company, minority shareholders. Next is step 3, calculation of revenue profit. So while calculating the revenue profit, the steps involved is, so before calculating revenue profit, we will look into the calculation of capital profit. What is the procedure or steps involved? You have general reserve, profit and loss, then you will add increase in the value of asset, you will minus decrease in the value of asset, and you will add a decrease in the value of liabilities, and you will minus increase in the value of liabilities. So that step is not involved here because there is no any assets and liabilities which is increase or decrease or which has been mentioned in the question. So we will stop with the general reserves and profit and loss, and then we will calculate the total capital profit and then distribute to your parent company and your minority shareholders. Next, when we calculate your revenue profit, we should know what is the profit or reserve which is earned after the date of acquisition. With that, we will have other calculations, that is according to your format. We will add excess depreciation charged on decreased value of asset and under depreciation charged in the increased value of asset. So in this question, we don't have any information about the depreciation, how it is charged, or whether it is charged on the decreasing value of asset or whether it is undercharged under in increasing value of asset. Any information relating to it is not specified in the question. So we will only check whether we have reserves or profit in the question. Yes, we have profit during the year 2014-15, which lies between 1st April to 31st 3 2015, which is the financial year. So what is the profit which has been earned by the Y Limited is 80,000. So this 80,000 will be divided on the ratio, that is the ratio which you have calculated in the first step, 4:1. 80,000 into 4 divided by 5, which will give you 64,000. Share of minority shareholders, 80,000 into 1 divided by 5, which will give you 16,000. So now we will as per the question, they have asked you to calculate what is the capital profit and revenue profit. You have done with that and you have got your capital and revenue profit. So the next problem is problem on calculation of goodwill and capital reserve. So now calculate cost of capital from the following. H Limited acquired 75% of equity shares in S Limited on 1st 10 2014 at 50% premium. The following balances are extracted from the balance sheet of S Limited on 31st 3 2015. Share capital 20,000 equity shares of rupees 10 each. Next, balance as on 1st April 2014. General reserves 50,000. Profit and loss 10,000. Net profit for the year 2014-15 is 80,000. So here, calculate cost of control. Cost of control, goodwill or capital reserve is the same. So please remember the terms. Goodwill, cost of control and capital reserve is same. When you have a positive balance, if you get a positive balance when calculating this step, then it is called as a goodwill. When it is a negative balance, you will be getting capital reserve. So now H Limited acquired 75%. So H is the parent company and S is the subsidiary company. So they have acquired 75% of equity shares at a premium of 50% premium. So then they have given us the share value, number of shares and per share value. Then on the balance sheet, that is on the date of acquisition, they have given general reserve and profit and loss, which will be used for calculating capital profit. Then they have given profit for that financial year, which is used for calculating revenue profit. So calculation of ratio of holdings. So number of shares in S Limited is 20,000 shares. So S Limited is nothing but your subsidiary company, 20,000 shares as per the question which has been mentioned here. 20,000 equity shares. So number of shares held by H Limited. So how many shares are H Limited acquiring? 75% shares at a premium of 50%. So what is the exact share they are acquiring? On 20,000 into 75%, which will give you 15,000 shares. So out of 20,000 shares, 15,000 shares has been acquired by the holding company, that is your parent company. What is the remaining shares? 20,000 minus 15, which will give you 5,000, which is the shares which has been acquired by the outsiders who are called as minority shareholders. So your second step is calculation of capital profit. So you need to check what is the profit which is earned up pre-acquisition or on the date of acquisition. So as per the question, balance as on first for 2014, general reserve 50,000, profit and loss 10,000. So you have general reserve on first for 2014 15,000, profit and loss on first for 2014 10,000. So the total which will give you up to 60,000, but you add the other item in the question which states net profit for the year 2014-15 is 80,000, but you need to check as you have given this is the profit for the year 2014-15, but in the question they have stated H Limited acquired 75% of equity shares in S Limited on 1st 10 2014. So the financial year is from 1st April 2014 to 31st March 2015, but the H Limited actually acquired the shares of S Limited on 1st 10 2014. So the parent company has bought the shares of subsidiary company in between, that is on October. So it is as it is in the between, you need to calculate the profit. This profit is for the year, for the full year. So you need to know what is the profit which is earned before acquisition. So 80,000 into, so as per the calculation, 80,000 into 6 divided by 12, that is from April, May, June, July, August, September. So it is acquired on October. So till September we need to know what is the profit, because that profit is pre-acquisition profit which is to be added on to which is to be added on to capital profit. So please do check the question. So you will be calculating the profit for the first 6 months, that is from April to September. So after October it has been acquired, that profit will be getting into your revenue profit. So 80,000 into 6 divided by 12, which will give you 40,000, is your pre-acquisition profit. So your total is 50,000 plus 10,000 plus 40,000, which will give you 1 lakh as your capital profit. So this profit will be divided in the ratio will be divided in the ratio 3:1. So how did you get this ratio is 15,000 shares of parent company and minority shareholders is 5,000. So 15:5, which will give you, for the simplification, 3:1. 5 ones are 5 threes are, so 3:1. So now H Limited, that is the ratio of H is 3. So it is 3 divided by 4, 1 lakh into 3 divided by 4, which will give you 75,000. And share of minority shareholders, 1 lakh into 1 is the share of minority shareholders into 1 divided by 4, which will give you uh, which will give you which will be giving you 25,000 rupees. So 25,000 rupees is the share of the minority shareholders. So next step is calculation of cost of control. So after you calculate your share of capital profit, you will be calculating your revenue profit. After you calculate your revenue profit, you will be calculating your calculation of non-controlling interest. But in this problem they have asked you to calculate the cost of control, which is nothing but goodwill and reserves, capital reserves. So you will be directly getting into the next step, that is calculation of cost of control. You will skip the step for calculation of non-controlling interest, because calculation of cost of control will not involve anything related to calculation of minority shareholders or non-controlling interest. So you can skip that step and get into your third step, as they have asked you to calculate cost of control. So to calculate cost of control, the format what they have given is purchase price of or cost of shares held by the parent company. With that, you will add parent company share of capital loss if you have loss, capital loss, or you will minus face value of shares held by parent company, and you will minus parent company share of capital profit. So now first we need to know what is the purchase value of shares. So now purchase value of share of shares of the parent company is, purchase value of shares of the parent company is 15,000 shares. 15,000 shares at what cost? So here it is at rupees 10 each, but they are purchased at a premium of 50%, which has been mentioned. So rupees 10 into 50%, which will give you 5 rupees as a premium. So your face value of share is 10 plus 5 rupees as a premium. So the total face value of the shares which you are purchasing is at 15 rupees. 10 plus 5, so 10 plus 5, which will give you 15. So the exact value at which you are purchasing the share is cost of 15,000 shares. So now 15,000 into 15, so 15,000 15,000 into 15 will give you 2,25,000. With this, we will add if there is any capital loss which has been incurred by the parent company. So that is what has been shown in the format. Purchase price of or cost of shares held by the parent company, add parent company share of capital loss. But in this problem, we have got capital profit. So we will minus capital profit. Along with that, we will minus the number of exact face value of shares held by the parent company. So now, as we have got profit, we need to minus the face value of shares first, then we will minus the capital profit. So the face value of 15,000 shares, what is the exact value of 15,000 shares before giving premium is 10 rupees 10. So 15,000 into 10 will give you 1,50,000 is the exact value of shares, that is after before charging premium on it. Next, we will minus H companies, that is your parent company's share of capital profit. So what is the share of capital profit what is earned by H is, H limited is 75,000. So 1,50,000, which is the face value of shares which has been held, that is 1,50,000, and the capital profit of the parent company 75,000. So the total will give you 2,25,000. So cost of shares which has been acquired by parent company, which is 2,25,000, and minusing the face value of shares of parent company and the capital profit of the parent company of 2,25,000, which will give you a zero balance, which is nil. So it is a goodwill. As it is a positive figure, it indicates goodwill. If it is negative, or the answer, if the answer is negative, you will be getting capital reserve. If it is a positive answer, you will be getting it or representing it as a goodwill. So the next problem is illustration 3, problem on calculation of non-controlling interest. Calculate non-controlling interest from the following: XYZ Limited acquired 56,000 shares of rupees 10 each in ABC Limited on 1st 10 2014. The following balances are extracted from the balance sheet of ABC Limited as on 31st 3 2015. Now, share capital 70,000 shares of rupees 10 each. General reserves on 1st 4 2014 is rupees 1,40,000. Profit and loss account on 1st 4 2014 2,24,000. Profit during the year 2014 to 15 rupees 1,20,000. So when we are calculating, they have asked us to calculate non-controlling interest, which is the fourth step according to your steps of control calculating your for calculating, or the procedures for calculating consolidated financial statement. So they have asked us to calculate non-controlling interest, which is the minority shareholders share calculation. So for calculating this, they have stated XYZ Limited acquired 56,000 shares from ABC Limited. So XYZ is the parent, ABC is the subsidiary. So how many shares? 56,000 shares they have acquired. So the following balance sheet is given. The exact share value of ABC Limited is 70,000 shares. Their general reserve for calculating capital profit, that is on 1st 4 2014, is 1,40,000, and profit and loss 1 lakh for on 1st 4 2014 is 2,24,000. Let us check into when they have acquired the shares from the subsidiary. So this is also like your previous problem, which is acquired in the mid of the year, which is on 1st October 2014. So we need to find out when you're calculating capital profit from the profit, that is the profit during the year 2014, which includes a profit before acquisition as well as after acquisition. So when you're calculating capital profit, we need to divide this for first 6 months and take that amount to your capital profit calculation. So this is similar for similar steps which is involved in your second second illustration, but in that second illustration we are calculating goodwill or capital reserve. In this we are going to find out non-controlling interest. So let us get into the solution. Step 1, calculation of ratio number of shares in ABC Limited. So what is the total number of shares of the subsidiary company is 70,000 shares. So we have taken 70,000 shares. So number of shares held by XYZ, that is your parent company, is 56,000, which has been mentioned, 56,000 shares of rupees 10 each, which we have been accounted here. Next is number of shares held by minority shareholders is 14,000. So how did you get 14,000? 70,000 minus 56,000 will give you 14,000 shares. So now we can further classify it. 56 is the shares of the parent is to 14. So 56 is to 14. So 14 ones are 14, fours are is 15 6, which will give you 4 is to 1. So you can further also simplify by taking into the least number of the tables. That is by taking your 7 tables. 7 twos are 14 and 7 eights are 56. So further, so you'll be getting 8 is to 2. So 2 ones are and 2 fours are, which will, 2 fours are is 8. So you'll be getting simplified answer is 4 is to 1. So 4 is to 1. Now you will calculate the next step, calculation of capital profit. So general reserves on 1st for 2014 and cap profit on 1st for 2014 is to be accounted, which is 1 lakh 40 and 2 lakh 24,000. So general reserve on 1st April 2014 is your pre-acquisition profit, first for to the 1,40,000, and profit and loss on 1st for 2014, which is 2,24,000. We will be adding up. Then you have, as this is as the parent company is acquired the subsidiary company in the mid of the year, that is on 1st October 2014, we will be taking the from the overall year's profit, we will be taking the part which is belonging to pre-acquisition profit, that is before acquiring, what is the profit they have, what is the profit subsidiary company has earned. So what is the profit which is given during the year? 1,20,000. So when is the parent company acquired the subsidiary? On 1st October. So April, May, June, July, August, September, 6 months. So 6 months profit will be taken over. So 1,20,000 into 6 divided by 12 will give you 60,000. So the total capital profit 1,40,000 plus 2,24,000 plus 60,000, which will give you 4,24,000 is your capital profit. So share of XYZ Limited is equal to 4,24,000 into 4 divided by 5. This is the ratio which you have calculated in your first step. 4 divided by 5, which you will be getting 3,39,200. Then share of minority shareholders 4,24,000 into 1 divided by 5, where you will be getting 84,800. The next step is calculation of revenue profit. So the profit for 6 months, that is 1,20,000 into 6 divided by 12. So as the profit which has been pre-acquisition profit, in the similar way the post-acquisition profit is also calculated. 1,20,000 into 6 divided by 12, which will give you 60,000. Next share of, with this profit what is earned, we will be dividing it in based on the ratio share of XYZ Limited out of the 60,000 into 4 divided by 5, which will give you 48,000. Then share of minority shareholders 60,000 into 1 divided by 5, which will give you 12,000. So next step is calculation of non-controlling interest. To calculate the non-controlling interest, the format what is given in the question is, so let us get into the format. So non-controlling interest format, calculation of non-controlling interest, face value of shares held by minority shareholders. With that we will add the profits as capital profit, both revenue as well as capital profit. If you're getting loss, we will minus the capital as well as revenue loss. So now your illustration 3, we have got profit for both the cases, and capital profit as well as revenue profit. So we will capital profit as well as revenue profit is being gained here in your illustration 3. So we will be taking your capital profit and revenue profit. So face value of shares held by minority shareholders is the face value, that is number of shares held by minority shareholders is 14,000. So 14,000 into rupees 10 per share, that is rupees 10, which is mentioned in the question, rupees 10 per share. So rupees 10 per share, which will give you 1,40,000. With that, we will add the profit of share of minority shareholders. So capital profit share of minority shareholders is 84,800. Their revenue profit of minority shareholders is 12,000. So capital profit as well as revenue profit 12,000 and capital profit 84,800 is taken. So when we add up, the total is 2,36,800. So in this problem, they have asked us to calculate minority shareholders share. So to that is your non-controlling interest. So when we want to calculate your non-controlling interest, we want both capital profit and revenue profit, and the ratio is must. So we have done calculation of capital profit and revenue profit. You can have a doubt in your illustration too, why we have not done the revenue profit calculation. To calculate your cost of control, you don't require the revenue profit calculation, because in that format they will only ask you cost of equity, cost of shares held by the which is held by the parent company, and with that you will minus face value of shares and H companies, that is parent company share of capital profit is only asked. So you don't require revenue profit calculation. That is why we have not done the revenue profit calculation in this illustration too. And here as they asked to calculate non-controlling interest, in non-controlling interest format you require both capital profit as well as revenue profit calculation, because that is there in the format to be added with the face value of shares of minority shareholders. That is why we have done revenue profit calculation. So thank you everyone. The other problems will be discussed in the next video.